How do I choose the right type of mortgage for my needs? If you're in the process of buying a home and are wondering how to choose the right type of mortgage, you're about to get all the answers you need. Let's break it down step by step. First, you need to decide between a fixed rate and an adjustable rate mortgage. A fixed rate mortgage means your interest rate stays the same for the entire loan term, usually 15 or 30 years. This is great if you plan to stay in your home for a long time because your monthly payments will always be the same. You can lock in a low interest rate and keep it, but you'll pay more in interest in the early years, and you can't take advantage of lower rates unless you refinance. On the other hand, an adjustable rate mortgage has an interest rate that changes over time based on market conditions. It often starts with a low introductory rate that lasts for a few years, then adjusts. This can be good if you don't plan to stay in the home long because you'll pay less interest in the early years. However, your monthly payments could go up if interest rates rise. Next, you should consider the type of loan. Conventional mortgages are the most common and are not backed by the government. You can get one with as little as 3 to 5% down, but you'll need to pay private mortgage insurance, PMI, if you put down less than 20%. These loans require a minimum credit score of 620 and a debt-to-income ratio of 50% or less. If you're looking to buy a more expensive property, you might need a jumbo loan. These are non-conforming conventional loans that allow you to finance higher-priced homes but come with stricter qualifying criteria, higher down payments, and higher closing costs. You'll typically need a high credit score and a low debt-to-income ratio. Government-backed loans are another option. FHA-insured loans are great for first-time homebuyers because they require as little as 3.5% down and have more relaxed credit requirements. VA-insured loans are for veterans and active-duty military personnel, offering favorable terms like no down payment and lower interest rates. USDA-insured loans are for rural areas and also offer favorable terms, including no down payment. When choosing a mortgage, it's also important to think about your financial situation. If you can afford a higher monthly payment, a shorter-term fixed-rate loan might save you money on interest over time. However, if you're on a tight budget, an adjustable rate mortgage or a longer-term fixed-rate loan might be more manageable. Finally, consider getting pre-approved for a mortgage before you start house hunting. This will give you an idea of how much you can afford and will make you a more serious buyer in the eyes of sellers. By understanding these different types of mortgages and their requirements, you can make an informed decision that fits your needs and budget. Remember, the right mortgage can make a big difference in your financial future, so take the time to choose wisely.